helicopter. In the wake of COVID-19, the Federal Reserve money helicopter flew directly to Wall Street and hovered. States, on the other hand, got a mere 5% of the nearly $3 trillion relief package in by early May, and remained desperately short of funds. Banks, on the other hand, or states, on the other hand, states, on the other hand, got a mere 5% of the nearly $3 trillion relief package by early May and remain desperately short of funds. Banks can borrow money virtually interest-free with no strings attached. States face higher interest rates and penalty fees. Bharat Ramamurthy, a member of the Congressional Oversight Commission, called them punitive rates in a hearing yesterday. And to discuss how these policies are affecting the people and how things might be different with a public bank, we have PBI Chair Ellen Brown and two important guests. Ellen Brown is the founder of Public Banking Institute and the author of The Web of Debt, The Public Bank Solution, and Banking on the People, Democratizing Money in the Digital Age. We have Professor Robert Hockett, who's coming in now. Robert Hockett is the Professor of Law at Cornell University, Fellow of the Century Foundation, PBI Advisory Board member, and is also a regular consultant for the Federal Reserve Bank of New York. And finally, we have Michael Brennan, the Democratizing Capital Policy Organizer for the Democracy Policy Network, or DPN, DEEPN, a new state-level policy organization supporting the rising movements entering state houses across the US, working to deepen democracy. Okay, Ellen, why don't we start out about why is this discrimination happening and how are these policies impacting the people? Or you can take the conversation from here.
Okay, thanks, Suzanne. I thought I'd let Michael start off with, he's done a lot of research on these issues. So Michael, can you tell us like what the basic problem is, what the current status of the situation is and why we need change? And then I'd love to hear from Bob on his proposals. I know he has some really good proposals on how to fix all this. So
yeah, thanks, Ellen. Yeah. So to start, we're in the COVID-19 pandemic, and one of the main issues that's come up is the funding to state and local governments. So within the CARES Act that was negotiated in late March as the federal response to the pandemic, they had two ways that they were going to be supporting state and local governments. The first was a provision of $125 billion from the Treasury to the state and local governments for COVID-related expenses, which actually didn't really help all the budget shortfalls that were coming about because of the loss of revenue due to COVID for the state and local governments, because it had to be tied to specific new expenses rather than the budget shortfalls, which they've since fixed. The other was a $50 billion capitalization for what's known as the Municipal Liquidity Facility, which is a program for the Federal Reserve to lend to state and local governments as a way of shoring up those revenue shortfalls. And so the problem is, and this was apparent in yesterday's hearing from the Congressional Oversight Commission, which is the body that oversees the dispersal of the CARES Act funds. They had a hearing with Kent Whiteshaw, I believe his name was, and he runs the Municipal Liquidity Facility out of the New York Fed. And he was making the argument that the function of the facility is to be a lender of last resort and back up the munis market, the municipal bond market, whereas we're arguing that it needs to be funding and making sure that the state and local governments, which are de facto federal response to the pandemic, are fully supported to deliver the services that are needed in order to then open the economy and avoid austerity down the line so that we can have a genuine economic recovery. And so a lot of this comes from Bob's proposals for what those changes to the Municipal Liquidity Facility, or MLF, look like.
That's great. Thank you, Michael. And Bob, then do you want to give us your, I know you've written a number of articles and we're attempting to get the Fed to change their rules. So can you comment on all that?
Yeah, sure. So I thought Michael laid it out really quite well, quite effectively. But just to sort of maybe briefly summarize, I guess the sort of line that both Michael and I have been taking, and you and Walt as well, of course, all summer, is that, sort of best of all, right? The best of all possible worlds would be outright grants appropriated by Congress, right? And that should be, of course, our top priority. But that's, of course, considered fiscal policy. And if we have to fall back on monetary because Congress doesn't end up acting, then the question becomes, all right, how best to do that? It seems to me there are two ways to do it, right? One would be, as you yourself, Ellen, have argued for a long time, simply using the standard, garden variety 14.2 authority, which only imposes one restriction, namely restriction to 6-month paper, and simply announce an intention to roll that over indefinitely for, let's call it, as long as it takes. I call this a sort of temporal Draghi, right? So just as Draghi said, whatever it takes, Powell would then simply say, as long as it takes, or for however long it takes. And you would simply say, look, as long as this crisis is in place, and this is the only lifeline to the cities and states and other sort of subdivisions of states to prevent mass disemployment or redundancies of public employees and mass shutdown of various programs that are keeping people alive and keeping people in their homes and the like, will keep this going for as long as need be. That would be, from my point of view, at least the sort of second best thing to do and the first best sort of monetary policy thing to do. Barring that, we stick with the Section 13.3 authority that's being used now. So that means that's just to say that we stick with MLF, but we fundamentally change the way it's currently constituted, because it's currently constituted pursuant to what I think we would all agree is a kind of category mistake, right? They seem to be thinking of 13.3 here as 13.3 was used back in 2008. So that's to say they seem to be thinking of it as a lender of last resort sort of functionality that's designed basically to keep too big to fail banks afloat, right? And so, as you know, the classic problem in a situation like that is you want, on the one hand, to keep these institutions afloat because the negative externalities imposed by their failure would be too much to bear, but you kind of have to hold your nose when you do it because it really is their own fault that they're in trouble. You're only rescuing them because they're too big to fail. So you deal with the moral hazard problem that comes with that rescue by imposing some kind of penalty so that it's not a sort of happy option. It's not something that they're happy that they had to resort to. That's to say that the banks. The municipalities should not be likened to too big to fail banks. But first of all, they're not in any sense responsible for their own harm, for their own risks, or what they're suffering right now. Nobody could plausibly say that they brought on the pandemic. Nobody could say that they're responsible for the fact that the White House is not compos mentis. Nobody can say, therefore, that there's some sort of moral hazard problem raised by bailing them out in such a way that, well, they're going to bring on another pandemic later if we do this. So what we do is we drop any reference to penalty rates. We also drop reference to market rates, because market rates has no meaning. That phrase has no meaning in this context, given that the intervention that is MLF was brought to bear precisely because rates had become effectively infinite when those muni markets froze up. That means in turn that the market rate is a policy variable now. It's not exogenously given, so it makes no sense to use as a benchmark. You determine it, you don't follow it. So you should drop, it seems to me, if we're going to stick with MLF, we should drop any reference to market rates as well. We should extend the term structure out from the current 36 months, which is already long since to have abandoned the notion of liquidity, which, as you guys know, we typically restrict to 6 to 12-month paper. As long as we've already thrown out real liquidity by saying 36 months, let's make it a useful non-liquidity. Let's make it 5 years, let's say 60 months, or even 10 years, right, if that's what's necessary. And there are various other sort of current categorical restrictions that are less severe than those, but that could also, I think, go, right? So it's great that we're saying 250 cities of 250,000 now instead of cities of 2 million. Great, very good. But why not bring it down even further, given how many entities, that's to say how many sub-federal entities are performing essentially federal functions? Why would you have to index it by population, right? If a particular entity is helping 1,000 people, but it's helping them it's performing a federal function in so doing, why not just say, well, extend the funds to them as well? And the way to limit it is on a per capita, right, or a pro rata basis. So you could say, all right, if you're servicing 1,000 people, if you're performing a federal function on behalf of 1,000 Americans, you can access this much, right? If you're performing federal functions on behalf of 250,000 Americans, you can access this much, which presumably is 250 times the amount that you would get if you were helping out 1,000. If you do it in a per capita way like that, you get rid of the last sort of artificial restriction, and then you enable this thing to sort of do what it really ought to be doing, which again is simply enabling sub-federal entities to perform federal functions in a situation where there just is no federal government at this point doing anything, right? And the Fed is the way to federally fund sub-federal entities at this point. It seems to be the only game in town, to use L. Arian's lingo here. But that's the sort of summary version, I would say.
Okay, thanks, Bob. That's great. Just for our listeners who may not know what you're referring to with Section 13, 14, et cetera. So Section 14 is that it says that the Federal Reserve can lend to states, but only for 3 months, 3-month limits. So that's what you're talking about, short term.
Right.
And then Section 14 is the exigent measures, like emergency measures, which obviously is what they're calling on right now and calling this an emergency. So, and you're arguing, and we're arguing that they need to lower the interest rate, make it equivalent to what, at least as low as what the corporations are able to borrow.
Yeah.
I mean, they have all these corporate liquidity functions, supposedly liquidity. As you point out, it's not really liquidity even, which is considered short term. And what we're looking for are the longer term loans. And the reason this is relevant to our listeners is that our state and local governments are broke. I mean, they're not taking in the revenue that they used to get because the businesses are shut down, and they've got more expenses than they used to have. Probably the biggest is unemployment. If we don't get money into the pockets of the people, we're not going to have an economy. You've got to have an economy consists of supply and demand. And in other words, you've got to have people buying stuff. Besides, you got to have producers producing, people working, but you've also got to have somebody who will buy that stuff. And so we've got to get money into the pockets of the people. And that unemployment insurance that they canceled was working very well until they canceled it. So we're hoping for some more payouts right into the commercial economy. The consumer producer, the real economy, as opposed to the financialized economy where they pumped trillions and did drive the stock market, worked very well to keep the stock market up, but that money never trickles down. Profits do not trickle down, they always trickle up. Okay, so
sometimes like guys are up. It seems like just
yeah. So we've sent petition letters or you drafted a very good letter to go to the Fed. What do you think the hopes are of having some influence there?
Great question. Yeah, great question, Ellen. I mean, there's sort of two factors here, and it's not clear which is the decisive one, but I guess we'll know soon enough. One factor could be that Mr. Powell and the rest of the board are just wanting to kind of hold off on doing anything kind of potentially controversial until after the election. They might be just playing it safe, kind of hunkering down. The other possibility is that they're much more sort of cautious even than that, and they're just kind of fearful about appearing to be encroaching on traditional fiscal policy prerogatives of Congress, and so stretching the meanings of monetary policy to kind of make up for absent fiscal policy. I hope that they're not that timid, right? I hope that they would be willing to kind of step up to the plate and push the envelope a bit, at least after Election Day. I would, in fact, of course, I think all of us would rather that they would be less timid than that even right now, and that they would have been less timid than this even in April. but it seems to me that at the moment, those are the two greatest likelihoods, right? The one is that they're just timid enough to want to wait until after Election Day. And the other is that they're even more timid than that, to the point where they're just afraid to basically push the envelope any further than they have. If in either of those two circumstances, one thing that could change things, actually, there are two things that could change things, right? One is if Congress actually did finally arrive at a renewed CARES Act or a HEROES Act that was acceptable, at least to both parties. That would take some of the pressure off of Powell, I guess, and then he would probably feel fine about being even more timid, or might just feel like it's not even a matter of timidity. It's just that, the right thing is now happening, namely the fiscal policy tool is being used. The other possibility, of course, is that doesn't happen, and then things just suddenly get much, much worse, right? There's sudden spiking all over the place. More and more people are, dying. More and more people are being furloughed or laid off, especially from public employment. And things start looking like they're heading toward just absolute terminal collapse even before Election Day. At which point one might imagine Powell himself finally saying, up yours, Mnuchin, we're going to do what needs doing here. If it's a choice between you and national suicide, if it's a choice between pleasing you, Mr. Treasury Secretary, on the one hand, and national suicide on the other, we're going to go with avoiding the suicide, and say that the Federal Reserve Act is no more a suicide pact than is the U.S. Constitution. That's how it kind of looks here.
Thank you. And I know you've written in unrelated, as I've written, that we should have a national public banking system, basically with the Fed at the top as the deep pocket at the top.
Yeah.
And so all the banks would essentially be chartered, or what do you call it? I'm trying to think. Mm-hmm. What's the word for?
You mean federal?
Basically,
franchise. Gotcha.
Franchise of this central bank system. Can you just spend a couple of minutes explaining your thinking along that?
Yeah, sure. So it seems to me that we can, speaking somewhat crudely, I think we can divide the nation's investment capital stock into two classes. There's public capital on the one hand and private capital on the other. The private capital is already pre-accumulated, right? So if Michael has a bunch of money in an account and he's already earned it, he owns it, it's his, we can call that private capital. And we can say that, if that is actually lent by somebody, that would be intermediated capital. But as we all know, the overwhelmingly greater part of capital is not of that form. The overwhelmingly greater part of capital is not pre-accumulated and intermediated. It is generated and then distributed or allocated. Now, the problem in the sense in which it's public.
I don't think people are going to follow that. So the bank creates the money the banks always claim that they are intermediaries, that
right.
they're just taking depositors' money and lending it out. But we know that that's not true. And that obviously would be true if you're borrowing from your grandmother, you're really borrowing existing money. But the way our system works now, all the money virtually all of it is created by banks and they make loans. Okay.
Yeah. And a lot of people find that at first sort of difficult to quote unquote wrap their heads around or kind of to intuit. But the way I find it easiest to sort of explain it, this makes it, I think, accessible even to non-banking folk, is to say, okay, what's the difference? Imagine that Michael wants to borrow some money. And he can go either to the Ellen Brown Bank, and let's say Ellen Brown really is a bank, or he can come to the putative Bob Hockett Bank, and I'm not a bank. Now, either of us, both Ellen and I, can say, we're going to approve Michael's loan application, and we can purport to open then an account in Michael's name out of which he can spend, and each of us can give him a really impressive looking chip card. Mine has my picture on it, yours has your picture on it, Ellen, yours is therefore more impressive. It's at least more attractive. Michael now takes your card over to the drugstore to pay for something. And it works, right? Because you're a bank, right? You're integrated into the national payment system, which is overseen and administered by the Fed. And so your chip card, quote unquote, counts, right? Even though all you've done is given credit to Michael and then given him a card that he can use to draw upon that credit, it still works as money. It counts in payment because the Fed administered payment system counts it. Now imagine that my card, I do the same thing with Michael. I say, I approve your loan application, Michael. And here's a really impressive looking chip card. It's got my name on it and so forth. The difference, of course, is that I'm not a bank. I'm not licensed as such an institution. I'm not integrated into the national payment system. Michael takes my card over to the Duane Reade, tries to pay with it, and they just look at him and say, is this a gag? What are you doing? This is not a bank card. Nothing happens. that makes all the difference, right? That which counts is what money is, that which counts in payment and fulfillment of a transaction. And it's the payment system that determines that. That's all Fed administered. What that means in turn is that all of the bank loans that are made, by duly authorized and licensed banking institutions, drafts on which then count in the national payments infrastructure, are basically generating money in the way that the three of us, or actually all of us with PBI, are often noting to people. But I'm hoping that by describing it in that way, I've made it a little bit more, kind of, again, intuitively appreciable by folk. Now, this has been known for a long time. This is not something that we sort of invented, right? I mean, the sort of the greatest modern economist that nobody seems to have heard of anymore, who actually first noted this and all of the dangers that come with it, but also all of the opportunities that come with it, was Knut Wicksell, right? The Swedish economist who wrote on this. He called it bank money way back in the late 19th century, but somehow or another we still haven't caught on over here. But in any event, it seems to me that given the essential public role in determining that portion of the capital stock, it's best to treat that money, or that portion of the money supply, namely the bank money component of the money supply, as a kind of public capital, public investment capital, because it can be used productively or it can be used speculatively. Because we currently farm out the allocation of this capital to private sector institutions, it doesn't end up being used productively. And that's because, of course, as we know, a financial system that has secondary markets, tertiary markets, enables basically profits and production to be decoupled. You can profit without producing in a way that you couldn't before the advent of secondary and tertiary markets and derivatives markets and the like. And there are various collective action predicaments, I believe, that basically prevent private sector institutions from allocating our public capital productively. And the only way, I think, therefore, to do this is to retake public capital under public management and let private institutions manage private capital. That's fine. So if Michael pre-accumulates a bunch of money, he saves up a bunch and puts it in a private sector bank, sure, let him, knock yourselves out, man. Allocate it any way you want, as long as it's legal, as long as you're not money laundering it, or you're not financing Murder Incorporated or some other entity of that sort. But when it's public capital, when it's lent capital, i.e. when it's Wicksellian bank money, the public has to manage this, and the public can do this. It can do it productively. In fact, if you want a clue as to how to do it, just go back to the original purpose, the original idea behind the Federal Reserve System that basically operated at two tiers, right? There were the regional Federal Reserve banks on the one hand, and then, of course, the Federal Reserve Board at the apex on the other hand. Those regional Federal Reserve banks were basically meant to be a kind of network of local development banking institutions, right? They were meant to be monetizing through discounting commercial paper issued by productive enterprises, not financial paper issued by Wall Street banking houses. And that's why there was actually productivity that was financed in this country for a long period of time, let's say, until financialization really kicked in starting in the 60s and 70s, right? I think that a really fine start to going back to the public management of public capital and the private management of private capital, which I call the capital commons arrangement, would be simply to rediscover even the original purpose of the Fed as a public bank that has both local or regional outlets on the one hand that are focused on production, not speculation, and then a Fed board at the apex just to sort of coordinate nationwide to make sure that you're not getting an excess generation of credit as a sort of aggregative thing, right? So I sometimes conveniently distinguish, I'll say that the apex is concerned with the modulation of the credit money supply, and then the regional Federal Reserve banks should be concerned with the allocation of the credit money supply. And this is not that difficult to do. There's a big paper I have coming out. It's just titled The Capital Commons. I can't remember whether I've sent it to you guys yet, but I will if I haven't already. That basically tries to lay out the whole thing, and it turns out to be surprisingly easy to do. It's not conceptually difficult, and it shouldn't even be operationally difficult. And it wasn't back when we did it. But somehow or another, we've completely forgotten about all of this because we think, oh, the Fed is just about basically making sure that giant banks that only bet on price movements in secondary and tertiary markets don't fail because we all need them, because otherwise we have no credit money and we all go back to subsistence level production and we're wearing animal skins again. But that's just, as we know, that's just complete and utter rubbish, right? And I guess the key is to sort of for us all to figure out ways to kind of communicate all of that in ways that are accessible to people who don't spend hours, as we've done, sort of learning banking jargon or finance jargon, right?
Right.
That's systematically translating everything into ordinary language that real human beings understand, so that you don't have to be some banker or some nerd like us, if you'll pardon my extension of that description to you to sort of get or to understand.
And I think that the issue that, we're here to talk about the municipal liquidity facility. I think that explanation does a lot of work to show why that intersects with this analysis of banking, right, and bank money. Because, like you've said, what we're trying to do right now is show the public utility function of the banking system.
Yeah.
And when state and local governments are reliant on private markets for financing, especially in a pandemic and in crisis situations, their financing needs, we are effectively giving to the private franchisees of the public monies the ability to control our ability to even manage this crisis, right?
Yeah.
And I think that the problem ideologically that we're running up against with the MLF is that the Federal Reserve, and like we saw in the hearing yesterday, they think of it as stabilizing these private franchisees, and that if it doesn't work, then we're stuck pretty much, that there's no solution there other than Congress passing a stimulus and giving direct aid. But we're saying that there is an alternative. You already are distributing public monies, and if you administered it in a different fashion, in a way that actually went directly to the public via state and local governments, and a monetized, if they issued to the Federal Reserve directly, and then they created public money that then they could spend for the public interest by managing the crisis, then we've, I think, successfully made that argument about the function of credit and bank money, and central bank as the way of doing that. And it points to, I think, the function of public banks as administrators of that over the long term, right? So the MLF is the way of introducing that to state and local governments, right?
Yeah.
Their ability to, go ahead, Bob.
Well, it also links up with this other thing that we've, of course, as a team been pushing ever since April, which is that, it makes no sense to administer this only out of the New York Fed, right? So I think we're all on board with the spread the Fed idea, and that the MLF should be administered out of all of the distinct regional banks, precisely because each regional bank has expertise in the municipalities that are within its jurisdiction. So if you're really going to relocalize, which is sort of what MLF amounts to, a kind of the beginning toward doing, well, then do it the right way and spread the Fed, have every regional Fed bank administer MLF for its territory. And in doing that, then you will also, in the very doing, kind of be moving closer, a little bit closer back toward what the Fed was originally meant to be in the first place, which again was this kind of regional network, or this network of regional development banks, right? You've in effect taken the first step toward restoring the original purpose of the Fed in doing this. So we could almost sort of say, okay, look, we have an emergency, MLF is for that, we now spread the Fed again, we go back to that. That then provides the kind of, in a way, the beginnings of a restoration of what we can think of as this capital commons, right? Where the public bank, which is the Fed system, is responsible for the allocation as well as the modulation of public capital. And then we can let the private banks deal with the private capital. Those would basically be the narrow banks. Those would be the Irving Fisher banks. You say, all right, banks, you want to be intermediaries? Then be intermediaries. That means you don't get to distribute public capital, right? That means you only get to distribute pre-accumulated Michael Brennan capital, right? And then if you're going to be distributing public capital, then don't call yourself intermediaries, because that's not what you're doing. What you're doing is you're allocating a publicly generated financial resource. And that means you're going to be subject to very strict publicly imposed conditions in doing so. And one of those conditions is going to be that these are productive loans, not speculative loans. And then we can add other conditions that we think are helpful, like, for example, maybe a preferential option for employee-owned firms or employee co-determined firms, right? Or, local or small businessy firms instead of bigger ones, which probably really don't need this kind of money anyway. They tap the capital markets. So, I think we could actually make this we could make MLF not only into something that's better than it is now, but also something that kind of begins us on the path back toward restoring that original Fed. Oh, sorry, Ellen. Yeah.
Oh, that's great, Bob. I just thought I'd point out it's 3:31, and I know you have a class.
Yeah. I guess we better take off to go
I can wrap up with, okay. Okay, thanks so much. That's also
Thank you so
helpful.
much,
I'm
guys.
looking forward to your
Okay,
paper on
Oh,
that.
thank you.
We can build on that for sure.
Oh,
You
that'd
know
be
what I
fun.
love is that if we all had like credit cards or debit cards to this public system, yeah.
Exactly.
Well, we also need to discuss a national infrastructure bank, which
We'll do
I
that
know
too.
you're also working on, and we could do
Yeah.
that, maybe a follow-up.
Let's do it.
when
I'll send that stuff to you this afternoon, and we'll talk more.
Okay.
All right. Thanks, guys. More soon then. More to come.
Bye.
Bye
Thank
for now.
you, Bob.
Okay, I'll just say I saw there was one question of how do we get from here to there, and what does this have to do with public banking, or specifically AB 310 in California, which is a bill to turn the infrastructure bank into a public, a state bank, state-owned bank. So what we would argue is that the first thing, the easiest thing a state or big city could do is form their own bank. And then you will have the ability to borrow from the Federal Reserve at 0.25% interest, like almost nothing. And, these loans can be rolled over and over, and there are no strings attached. They don't even care, what you use the money for. I mean, they don't care what the big banks are using the money for. They don't care if the big banks are still charging 21% interest on average for their credit cards, which they are. I mean, they should require that if the banks are getting these very low interest rates, that we should be getting low interest rates as well. They should have to drop the rates, but none of that is in there. So anyway, it would be a great deal for a state or local government to have their own bank and to be able to get these very cheap rates, which are even better than the rates being given to the big corporations that we're arguing that the municipal liquidity facility should give to state and local governments. So I guess we need to wrap up. Thank you so much, Michael, and thank you so much, Bob, who is gone, and Suzanne.
Yes, I just wanted to just say thank you to all of you, and if all of you viewers, if you would like to see more, please subscribe to us on YouTube as well, and follow us on Facebook, please. And we have a new Instagram account if you would like to follow that as well. And what else? Are there any other questions? No, I don't see any particular questions, but yes, thank you so much. It was a very important discussion. And if anybody wants to have a town hall to discuss these kind of issues and why public banks are important for your community, please contact Public Banking Institute as well. Thank you, and see you next week.
Thank you, Suzanne. Thank you, Alan.
Thank you, Michael. Thank you, Suzanne.